U.S. stocks are on track for their best week since the election of Donald Trump. And my next guest says earnings season is crucial to the trajectory of equities, particularly for the banks. Joining me now from Atlanta is Keith Buchanan, Senior Portfolio Manager at Globalt Investments. Hi, Keith. How are you this morning?
Great, Mark. How are you?
Very well, thanks. Thanks for being with us. Now, first off, in terms of Q4 24, those are the earnings we're seeing revealed the last while, and we will see for several weeks now. You say that there are tough comparables compared to last year. Could you explain that?
Sure, Mark. We've been doing a lot of work around this trajectory of earnings and what it means to this part of the cycle. And this quarter that we're into a reporting period now, or fourth quarter of 2024, is the first quarter anniversarying growth after the earnings recession in early 2023. Fourth quarter of 2023 was the first quarter of growth coming out of that recession. So we're finally comparing a growth environment to another growth environment from an earnings standpoint. Therefore, the easy comparables are behind us. And now we get to what's sustainable growth after the rebound that we experienced over the last 4 quarters. So it's critically important to see momentum of earnings coming out of the earnings recession that we had early in 2023.
And you say you see 2 main challenges for equities. One would be higher bond yields looking more attractive to investors as an alternative, and that valuations make some companies vulnerable. So can you elaborate on that?
Absolutely. We've seen over the course of time, over the past, especially the past 7 to 10 years, this yield environment is incredibly attractive on a relative standpoint. And the valuations have to support money still moving into and finding the most attractive capital markets class, which is how we think of things working in the world from a fundamental standpoint, to still move into equities to justify not moving into fixed income to soak up that extra yield that this environment offers. Also, secondly, from a valuation standpoint, on any type of discounted cash flow, there's an element that's based on the rate environment. And the higher those rates go, the more you have to demand from those equities, particularly those longer duration, call it higher growth, less profitable names, come under more pressure when that is discounted at a higher rate, which we are in a higher rate environment right now. So there's more pressure on earnings to come through and fulfill that gap of question of whether the valuation is warranted, given this higher rate environment of more attractive assets within the investment landscape.
All right, Keith, in terms of earnings per share generally, overall, what is the forecast at your firm?
Right now, we're looking at 11% growth this quarter, and it's critically important coming into a year where we expect around 14% earnings growth. Again, this is with tougher comparables to 2024 and late 2023. So we see acceleration. I think that this is not really away from consensus and earnings that could justify the higher elevated valuations here at 21 times or so for the S&P 500. Anything short of that, particularly from a margin standpoint, would draw a lot of concern on our parts. Thus far, we've seen very, very healthy, not only results for 2023, but guidance for the banks was really impressive. And so we're looking into 2025 with the rhetoric that they see from the economy that was also very optimistic as well. So right now, so far, so good. The banks kind of set a tone that's positive, and we'll see how the rest of the earnings season goes.
So, Keith, you're saying essentially that if there's a company out there that's trading for, say, 25, 30 times earnings, maybe much higher than they have historically, as long as the earnings growth is acceptable, then it can justify the valuations. Is that about it?
What's acceptable on an earnings standpoint, a lot of times can depend on the discount rate, which is the yield environment. So the higher rates go, the more you demand from the earnings. That's why we feel like this earnings period, again, for the fourth quarter of 2024, but also the rhetoric and guidance for 2025 is critically important to justify the valuations, which are higher from a historical standpoint because of growth that has been so substantial. So we'd like to see a lot of vibrance this year from not only the expectations for 2025, but also the acceleration through the end of the year, which could carry into 2026, when also earnings growth is expected as well in the mid-teens area as well.
And Keith, this week we've seen quite robust numbers coming out of the big U.S. banks. How would you characterize what we've seen from the likes of Goldman and Bank of America, J.P. Morgan, et cetera? And why are these earnings so important as to basically extrapolate into the rest of the U.S. economy?
Absolutely. If the U.S. economy and the broader stock market is an engine, the financials is kind of the lubricant that's there, that keeps the pistons moving smoothly. So setting the tone, I think it's appropriate that they report early in earnings season. It kind of sets the tone for what to expect for the rest of the earnings season and also the rhetoric going forward. Net interest income was high across the board. We're seeing record profits on trading, call it from the lending book as well. So everything's kind of clicking for the banks, and also the valuation that you pay for these banks isn't really historically at a very high level. So the case for owning banks is kind of making itself at this point. Even beyond that, the commentary around the activity they're saying market-wide is also critically important as we get a read through to how the economy's doing and how they're also positioning themselves to benefit their shareholders in 2025 for the rest of the year as well. So the rhetoric is important, and also the results are speaking for themselves.
And lastly, Keith, the day after President-elect's inauguration on a Monday, on January 20th, do you expect some fireworks?
Not really from a political standpoint, no. We'll see how.
I just mean in the markets.
Oh, no. So, no, what we're looking for is how do the political campaign promises evolve into policy? And that will have an impact on economic growth, particularly from a monetary and fiscal policy standpoint. So we're watching it closely, not necessarily in a purely political lens, but how it impacts the markets, I think, is really important. And we'll see that start to shape up over the next couple of weeks, particularly the personnel and how things start to shape out and the rhetoric coming out of the early weeks and what's important on the first 100 days will have an impact on markets, and we're watching that closely.
Good to see you, Keith.